The last 18 months, virtually all of the buying in gold has come from central banks. Virtually all of it. I mean, ETFs have had steady outflows for the last 18 months, other than February, March. Even in the last month, they've had outflows. All the coin dealers I talked to, sales are down, premiums are down. So all of the gold buying in the last 18 months, primarily, virtually all of it has been from central banks. And so the danger there, when you're looking at literally a handful of players who've supported the gold market, they can decide not to buy for 2, 3, 4 months for whatever reason. Supposing China doesn't buy any more gold for 3 or 4 months, for whatever reason. Doesn't mean they've changed their mind, doesn't mean they're going to start selling anytime soon, but that would have a meaningful impact on the price of gold. Other than something like that happening, no, I think it's almost certain that the price of gold will go up.
Adrian Day, president of Adrian Day Asset Management, expresses confidence in the upward trajectory of gold prices, citing three main reasons. Despite a relatively slow start to the year, analysts anticipate the potential for gold to set another record in 2024, building on its previous achievement of reaching a record annual price in 2023. According to a recent London Bullion Market Association survey, member analysts foresee the gold market achieving a record annual price of $2,059 per ounce in 2024. This projection reflects a 6.1% increase compared to the previous year's record of $1,940.54 per ounce. Day argues that gold performs well during recessions, challenging the conventional wisdom that investors typically favor broad stock markets during economic downturns. The recent rally in spot gold prices, with a 0.3% increase to $2,043.80 per ounce, aligns with the anticipation of the Federal Reserve cutting interest rates. The yellow metal has experienced a price surge for the fourth consecutive day, reaching a 2-week high of $2,055.89 on Wednesday. Day highlights the shift in gold ownership dynamics, noting that central banks have been the primary buyers of gold over the past 18 months, while exchange-traded funds have witnessed outflows. The World Gold Council's recent report for the fourth quarter and full year 2023 sheds light on the overall gold demand trends. The report indicates that annual gold demand, excluding over-the-counter markets, amounted to 4,448 tons. While this figure represents a 5% decline compared to the robust demand in 2022, the inclusion of OTC markets and stock flows results in a total gold demand reaching a record 4,899 tons for the year 2023. Join us as we delve into insights shared by Adrian Day. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
The last 18 months, where virtually all of the buying in gold has come from central banks. Virtually all of it. I mean, ETFs have had steady outflows for the last 18 months, other than February, March. Even in the last month, they've had outflows. Coins, all the coin dealers I talked to, sales are down, premiums are down. So all of the gold buying in the last 18 months, primarily, virtually all of it has been from central banks. And so the danger there, when you're looking at literally a handful of players who've supported the gold market, they can decide not to buy for 2, 3, 4 months for whatever reason. Supposing China doesn't buy any more gold for 3 or 4 months, for whatever reason. Doesn't mean they've changed their mind, doesn't mean they're going to start selling anytime soon, but that would have a meaningful impact on the price of gold. So, other than something like that happening, no, I think it's almost certain that the price of gold will go up. First of all, for three reasons. First of all, I think three, I don't know. First of all, if you look back at every time the Fed has started cutting rates after rate hiking cycle, the next time they start to cut rates, gold has moved up dramatically. And that's logical. The second thing...
Who's counting, right?
Who's counting? Well, that's the first thing. The second thing is that if we are entering a recession, as I think we are, gold actually tends to do well in recessions. People think recession and don't want to be in gold stocks. It's a logical kind of thing. Oh, Fed's cutting interest rates, I want to be in a broad stock market. But in fact, both of those things, historically speaking, are fallacious. The broad stock market starts to fall when the Fed starts to cut rates. And it's not because the stock market falls because they're cutting rates. It's because the stock market is because in an environment where the Fed is cutting rates, typically you're in a recession. If we're in a stagflationary period, which I believe we're entering, with inflation up, and a recession, that means companies are going to get hit by higher costs and by lower sales, and so their profits are going to get squeezed. That's on the broad market. As for gold, again, it's not so much that a recession is good for gold, it's just that in a recession, the Fed starts to cut rates. Cutting rates is good for gold. So if you look back at the last, all of the recessions, so 10 recessions end of the 1960s, in all but one of those recessions, gold went up. And the one where it went down was in 2000, the dot-com bust, where it dropped by half a percent. That was when the European banks were dumping their gold, if you remember.
Right.
So in pretty much every recession out there, gold has gone up. In a majority of recessions, gold stocks have gone up, which is sort of surprising. And in the three recessions where gold stocks went down, they went down by 2%, 4%, and 5%. The ones where they went up by 30%, 80%, 197%, etc. So a majority of recessions, gold stocks have gone up and gone up by a meaningful amount. And here's the critical key. Yeah. In every single one of those recessions, gold stocks outperform the S&P. I definitely think it's true, but if you're in an environment where the gold price is going down, you have a very, very significant headwind, and it's very difficult for any stock to any gold stock to make money. And the opposite is true. If the gold price is going up a lot, rising tide raises all ships and all that stuff. So you've got a tailwind. I mean, broadly speaking, if the gold price is not going up, you really don't want to be in gold stocks, broadly speaking. But you only have to look at a stock like Franco-Nevada, which did very well from 2011 to 2018, when the gold price fell sharply and other gold stocks were down 80%, still did well, still gave you a return. I can't quote it off the top of my head because, sorry, I wasn't looking, but it still did well. So broadly speaking, I would say that your statement is true, and it's certainly true of the producers more than the exploration companies, because of course an explorer can have a great discovery, and that will build value whether the price of gold is going up or down.
Adrian Day asserts that gold is poised for significant growth, particularly when the market perceives indications that the Federal Reserve, Fed, is on the verge of initiating interest rate cuts. The swift recovery observed in the gold price during Thursday's early New York session indicates the ongoing market sentiment, with investors closely monitoring the possibility of rate cuts by the Federal Reserve in the current year. Day predicts that inflation numbers will begin to rise again by the end of the second quarter or third quarter. This forecast aligns with the recent headline U.S. inflation data, which exceeded expectations by 3.4% in the year to December 2023, up from 3.1% the previous month. The higher-than-expected inflation figures provide additional rationale for the Federal Reserve to maintain borrowing costs at their current 22-year high. This decision will be revealed in the upcoming interest rate decision at the end of this month. Let's get back to the interview.
I've said for 2 years now, but gold will really take off when the market believes that the Fed will start cutting rates before they have quashed inflation. And we are right at that point right now. It's quite clear that the next move from the Fed will be to lower rates. Personally, I'm not quite as optimistic as some people are about the timing, when they will do it and how rapidly they'll do it. But there's no question that the next move will be a cut in rates. And once the Fed starts cutting rates, there'll be a whole series of them. And yet at the same time, they have not quashed inflation. Now we look at the CPI or the PCE numbers and you see, they've come down dramatically. But in the last few months, they've sort of stabilized and started in the US moving up a little bit, depending on what you're looking at. In Canada, they're kind of flat for a few months. My point is they have not yet killed inflation. And if you look at the Fed's own preferred measure of inflation, which is core PCE, we're still 60% above their own target, which is an arbitrary target to begin with, but we're 60% above their target. My sense is that we'll start to see inflation numbers pick up again, end of the second quarter, third quarter. We'll start to see them pick up again, partly from the base effect, because it's partly the base effect that made the numbers so low in October, November, December, because we were comparing with a year ago when they were higher. That base effect is going to flip a little bit as we get into May, June, July, August. So that's one thing. And the other thing, of course, is oil. Oil is particularly low right now, or is low right now, I should say. So the potential for oil to move up over the next 6 months, I think, is real. And of course, if the price of oil moves up, that affects the price of every good in the store. So I'm not an oil analyst, and I'm not putting money on a higher oil price. I think the risk in inflation is on the upside, not on the downside. I think a recession is inevitable, all but inevitable. Nothing's inevitable, except death and taxes. But I think it's all but inevitable. And all of the indicators you look at, whether it's a leading economic indicator, whether it's manufacturing, all of the indicators are pointing down. The increase in debt, I think, is a very significant one. You look at the debt levels on credit card balances, you look at credit card defaults, because of course the balance goes up before they default. Both of those have shot up to 10 and 20-year highs, depending on which one we're looking at. And it's worse among credit cards like Capital One, Discover. It's worse there than it is, say, at Chase, but certainly worse than American Express. So Discover and Capital One are credit cards that typically, their market is more lower income people.
Yeah.
And those are the people that are really hurting. So when you have over 5% of your credit card defaulting, that is an astonishing number when you think about it.
The yellow metal has backed down from its session highs on reports an Israel-Hamas ceasefire may be close at hand. However, there has been no confirmation of such. Safe haven buying and bullish daily outside market forces, including a weaker U.S. dollar index and a dip in U.S. Treasury yields, support gold. How might geopolitical tensions, particularly the situation in the Red Sea, continue to influence gold prices in the coming weeks? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.